Okay, let's answer some questions from Sunday's market outlook. I understand the Taylor rule is the more empirically accepted formula, but what are your thoughts on the Mancu rule? Core PCI less the unemployment rate. Currently, I'm getting 2.4%, which is where FFR lies. That is part of the Mancu rule, but it is not the whole thing. There are two versions of it. It's a fitted formula. It's meant to fit the data. So there is one for the 90s, which is 8.5% plus 1.4 times what you cite here, core inflation minus unemployment. Core inflation is meant to be the last 12 months, and unemployment, if you go back to the original paper, unemployment is defined as the seasonally adjusted rate. For 2007, a better fit of the data was 9.9 plus 2.1 times the difference. So if we apply that rule, we have 5.9, which we saw this morning. We have unemployment at 3.5. This is prescribing a Fed funds rate of 5.14%. Which is more than double where we are right now. If we use the data from 2000 to 2007, because again, this is not a prescription, this is a description. It's a description of monetary policy. It's meant to fit the data. You get 4.86%. So if you average the two, 5% would be the Fed funds rate. We're at 2.25. I don't know that there's any analyst calling for 500 basis points on the overnight rate. There are some that think it will see over 4 before it stays there for some period of time, and it maybe starts coming down later in 2023. The Fed funds futures has a different opinion, suggesting that 3.4 to 3.5% is going to be the high point, and then it's going to hang out there for a couple of hours and then immediately start coming back down. I think the market has it wrong. I don't know that this is really where we're going to head, but I also don't think that 3.5% is where we're going to stop. So somewhere in between there. Next question, can you link the regression video for the two-year funds rate, versus the Fed funds rate? I thought that was on YouTube, and that was my bad. It is in the applied series on the website. It is behind a paywall. If you have a subscription for level 1, 2, or 3 CFA, I have put it in the appropriate section. So this would have been in the regression section for level 1 and level 2, and for level 3 it would have been in the economics section, capital market expectations section. I've often heard there are 3 Ds of deflationary pressure: debt, disruption, and demographics. So I put 1, 2, 3 on them. Here, though, we're seeing demographics play an inflationary role as older generations leave the workforce and wages increase due to demand. Well, what we're seeing right now is a combination of 2 and 3. Is you have disruption and demographics playing out at the same time. If the pandemic had never hit, a lot of the retirement that did happen wouldn't have been accelerated. It would have happened over time. And immigration levels would have been at the levels that they were, and maybe would have increased as we saw the participation rate decrease slowly over time. It would have been a slower moving outcome, so that you could have had time to adjust. Companies and the economy would have had more time to adjust in terms of automation and technology. You would have had a multi-year timeline to adjust, not a matter of 12 months. So really what we're seeing in terms of inflationary pressure is more of the disruption and less of the demographics. The demographics were going to happen anyways, but there's a difference between being given 5 to 6 years notice and being given 12 months notice. You don't have time to respond within 12 months. So a couple of things happen at the same time. You have an acceleration of retirement, and you have a drop-off, a significant drop-off of immigration happening at the same time. That creates your disruption, which overpowers the move in the demographics. As people age, they do consume less. If you want to see what the next 20 years may look like, you can look at the last 20 years of Japan. so that in 20 years, most developed economies, unless they embrace much higher levels of immigration, unless they do that, they do have a Japanese-style deflationary future ahead of them. As the peak consuming years, by the way, are 45. On average, those are the peak consuming years that individuals consume up to 45, and then they have the house, they have the cars, they have the furniture, the kids are out probably, at 45, maybe they're just entering university and they're leaving the house now, and then it tends to decline after that. So with the biggest generation now being aged 55 to 75, consumption is going to drop every single year. It drops significantly after 65. But the U.S. is a little bit different than the rest of the world because it's a very consumptive economy. So there is a split between goods and services, and the consumer makes up about 70% of consumption. In a country like Germany, that's more like 50%, even less in places like Japan. So there is a shift from goods to services as you age, and as long as you can keep those services within the borders of the US, they might be okay. It might not go the way of Japan. Consume less and demographics become a net deflator. They will. It just is the nature of aging that as you get older, material things matter less and less. And it's more social things that matter more and more. And much of that stuff is free. Can you please outline why we are seeing inflation after all the money printing after COVID, but we didn't see inflation after the great financial crisis? At that time, they print record amounts of money during 2008, and I'd like to understand why that led to deflation until now. It didn't lead to deflation, it led to disinflation, which means inflation leaving the system. And a number of reasons for all of that happening. Globalization was still growing after 2010, 2011, 2012. Globalization meant that activities were going from high-cost areas to low-cost areas. Well, that drives prices down. Transportation costs really declined after the great financial crisis because they were super high before that happened. So shipping costs were really, really high, especially dry bulk, super high. So a lot of ships were being built during that period of time. Well, by the time they were all done and came online and hit the oceans, you had a massive flood of ships in 2010, 2011, to the point where shipping rates had gone from 80,000 a day down to 2,700 a day. So it really dropped costs. Automation continued, and that will always lower costs if you can replace humans with robots. And technology, because with technology you can get decreasing costs to scale as opposed to increasing costs to scale. So there's no diseconomies to scale any longer, which is why Amazon can keep getting bigger and bigger and bigger and bigger. Prior to this new millennium, the theory of the firm would ask the question, if a firm is so efficient, if being bigger is more efficient, why is the economy not just one big giant firm? And the answer to that was because after a certain size, it becomes inefficient. There are diseconomies to scale, so costs would drop and then start to increase after a certain point. Your marginal cost of production would then start to increase after a certain size, so that there was an optimal size to the firm. While when you have decreasing costs to scale, it doesn't have to. It can just keep decreasing and decreasing, which means the average size of the firm can get larger and larger and larger. So why is the economy not just one big giant firm? Well, we can't answer that yet because I don't think Amazon is done. We'll find out. Would you please explain the structure of the Federal Reserve? There's so many different members and different roles coming out speaking. It's very confusing who does what and whose comments are more important than others. So you have the Federal Reserve along with 12 regional banks, and here's a map of the regions. So the black squares are where the particular Federal Reserve Bank is located. So this is San Francisco over here, but you can see the whole territory it covers, the whole, well, all the way down here, the whole region it covers is there. So there is San Francisco. So you have all the 12 regions based on the color: Boston, Philadelphia, Richmond, St. Louis, Atlanta, Dallas, Kansas City, New York, Cleveland, Minneapolis, Chicago, and San Francisco. So there are 12 presidents because each of these banks has a president, and there's obviously a vice president if you have a president. The FOMC, which is the Federal Open Market Committee, this is the group that meets every 6 or 7 weeks and decides on interest rates. This committee right here is made up of a chair plus 6 governors. The chair is the head of the Fed, that is Powell, and 6 governors. These governors are not presidents of any of these banks. They are on the FOMC committee. So you have 7 members on that committee. They are voting members. They're all voting members. And, if you're a governor, you have a bigger voice because you are a permanent voting member until you're no longer a governor. And you could be a governor for years at a time. The next 5 members are made up from the Federal Reserve banks. One is the New York Fed. They have a permanent seat on the committee because they conduct all of the open market operations. So buying for the balance sheet, allowing the balance sheet to run off, and buying and selling to peg the interest rate within some target range, that's all handled by the New York Fed. So they're pretty important as far as things go. So whoever the president of the New York Fed is has a seat on the committee for as long as they're president. And then there are 4 others, and each of these serve 1-year terms. And they're based on the regions. So the regions are grouped together, and the 4 are chosen from, one maybe from here, one from here. You probably have something that looks like this. I don't know what the groupings are, but there are 4 groupings of the banks. And so let's say that this is the first grouping of these 3. One will be selected. Well, you got to get rid of this guy here. One will be selected as the 1-year term. And it's only a 1-year term. These are permanent for as long as they hold their position. This one here is permanent for as long as they hold their position. And these 4 are for 1-year terms. These 5 seats also have alternates because, well, what if these guys can't make it? They have alternates, usually the vice president. So there are your 12 voting members of the FOMC. So as far as Fed speak is concerned, these guys are important because they vote. These guys are important because they vote, but they're there for multiple years, so they're a little bit more important, with this guy being the most important. This guy, or this, I should say, this person being the most important. Alternates sometimes speak, and alternates are at the meetings, but they're just not voting members. Now, what about all the others? What about all the other 7 presidents? Well, they're at the meeting, and they can speak at the meeting. So they do have influence in the meeting, they just don't vote. So here are your voters: the chair, the 6 governors, and the 5 presidents. But everybody attends the meeting, everybody has a voice, anybody can influence policy if they want. If their argument is powerful enough, they can influence policy, but these are the voters. Okay, next question. Starts right here. We learned that bonds and equity are non-correlated. Let's be clear. Government bonds and equities are slightly negatively correlated and generally follow a 60-40 rule. Well, the correlation doesn't follow a 60-40 rule. Because there is this slight negative correlation, our asset allocation can follow a simple rule of 60% equities and 40% bonds. We assume that when equity market goes up, bond prices will go down, and vice versa. However, both bond price and equity valuations are both heavily impacted by interest rates, and they have been since 2009. For 2022, we are seeing both bond and equity prices move in the same direction. They have been doing that for the last 13 years. From 2010 to 2020, bonds were in a bull market, equities were in a bull market. So is there something that I missed, or is this a new relationship we should know about? It is the presence of the central bank in the bond market as the largest single player in the bond market, so that the yield curve is not a market-derived yield curve, and those are not market signals, those are engineered rates with very little information content. They do not reflect the price of risk, they reflect the desire of the central bank to engineer a certain type of outcome. In engineering that outcome, they have to lower rates to provide a good, healthy economy, which is bullish for equities. However, you have to engineer those rates down and keep them down, which is bullish for bonds. Absent the Federal Reserve doing that, you would have bond prices lowering as equity prices rise in an expansion. You would have that negative relationship in there, because interest rates, if you allow the market to set the rates, interest rates would have upward pressure due to increased inflationary expectations that would be built into rates. Well, you don't have that anymore, because when you have a central bank sitting on the curve, it doesn't matter what you do. The yields aren't increasing. Only if the central bank wants it to increase will it increase. Look at Japan. Look at where the 10-year rate is there. You have the Bank of Japan sitting on that yield curve. They own, I think, more than 50% of the outstanding government bonds now, if not even more. And they'll keep going because they don't want that curve to move. That is not the cost of risk. It is highly engineered. So any relationship that used to exist as a result of market forces will disappear as soon as you have non-market forces playing the game. So typically, if we look at a traditional business cycle previous to the new millennial, as the economy expanded, you would get inflationary pressure. The risk-free rate would increase. However, you have a good economy, so credit spreads would decrease. So equity prices would increase as profits increased. The risk premium on equities would decrease, which supported, you had not only rising EPS, but when this thing happens, you get multiple expansion at the same time. Well, if the risk-free rate is rising, bonds are dropping as the risk-free rate rises. And again here, government bonds. If we look at the cost of equity, it is using a build-up method, the risk-free rate plus a credit spread, because you have corporate bonds that sit higher in the corporate structure than equities. So corporate bonds would have the spread above the risk-free rate, and then of course equities are riskier, so there'd be some risk premium above a corporate yield for the cost of equity. So traditionally, as the economy expanded, this component would increase, but this component would decrease, and since we were in a good economy with good profits, this component would decrease as well. Which was supportive of equity prices. This was not supportive of bond prices. And then, of course, the opposite would happen. As we entered into a recession, interest rates would drop, which would boost bond prices. However, credit spreads would widen. Profits would drop, so the risk premium would increase, therefore equities would drop. There's your negative correlation between government bonds and equities. Well, now, because the equity markets are so used to easy policy, if the risk-free rate increases like it has, bonds will drop. This is the first half of 2022. However, there's a fear that higher rates will break the economy. So credit spreads widen and the risk premium increases and equities will drop. Equities drop, bonds drop. This is what you have to move away from. This idea that the equity market can't live with a 3% Fed funds rate or a 5% Fed funds rate. This is, remember, in 2006, the Fed had rates at 5.25%. Unheard of over the last 13 years. We look at that and we think, how can you ever, that's history. Wow, what was it like to be alive then? That was normal. What we've seen in the last 13 years is abnormal. And whenever you have something abnormal and non-market forces playing, traditional relationships, traditional correlations will break down, which means going ahead, forecasting forward, You can't really forecast the correlation forward until you forecast the relationship of the Federal Reserve with the yield curve. Will they back away from the yield curve and allow the market to take over from here? Will they revert back to their role in 2004, 2005 of monitoring what the market is doing and responding to inflation? Or will they go back to what they did over the last 10 years and engineer a yield curve that they feel would engineer the type of economy that they want? Once you answer that question, then you can determine whether that negative correlation will return. Okay, a couple of questions here. And these are always the hardest to answer when we start talking about the effect of currencies. With the country of Sri Lanka defaulting on its debt recently, and many looming debt crises that are around the corner, when you say many looming, I have to say, well, it's easy to say the words many looming debt crises, and then we become married to that idea that there are many. Are there many? Whenever you use language that is in terms of quantities or in terms of intensities, stop for a minute and ask yourself, what evidence do you have of that? Are there many looming debt crises? Or are there some potential debt crises? Argentina has risk of defaulting on almost 400 billion, Egypt 150 billion, China might almost have 58 billion of loans heading for default for the mortgage crisis. On a global scale, this is super small. 600 billion on a global scale, that's super small. 25 years ago that would have been big, but now it's and it's not as if it's all held by one fund or one person or one government. This is all widely held. So let's say from the perspective of the US, what implications would this have on US Forex? Minimal, if any. Federal Reserve balance sheet, nothing. The Fed's not holding any of that stuff. Overall health of the US economy, minimal. Are there tools to assess the likelihood of sovereign debt default given some measure of volatility to calculate probabilities? The best site I've seen is the CFR Sovereign Risk Tracker. The link is in the description box below. A default is nothing overall. It really is nothing. Especially these amounts, they're really nothing, and it's not as if these are coming out of nowhere. These are probably expected and already priced in, and for the most part would have almost no effect other than, oh, did you hear about this? What is the bigger concern is the unknown. Is there a contagion effect? Does one falling topple a domino that causes another one to fall, which then causes yet another one to fall, and then another one to fall? For that to happen, this debt would have to be held in a very concentrated way in some very important financial institution somewhere in the system, where if that drops, a whole bunch of things end all at the same time. There has to be some kind of contagion effect. But if there is no contagion effect and a country defaults, oh well, it defaults, and it would be contained to the fallout in that particular area. So it's very hard to predict the outcome of all of this. We know that there are going to be defaults, so there should be heightened risk around those countries and around those types of assets, or even proximate assets if we're worried about emerging markets, because two of them seem in trouble. Well, then that might spread to all emerging markets, and risk premiums would increase in all emerging markets. It is that you have to think about. Does that cause a cascading effect? And if it does, is it contained? Or does it spread to more economies and more institutions? Is it something that is global, regional, or very specific to a particular country? Almost impossible to predict. All you can do is say, how resilient are we if a scenario like 1997 happens again, or if a scenario like 2007 happens again? And organizations would build resiliency based on scenario analysis to make sure that if something like that happened again, they would survive it. What is the impact of hawkish turns of Feds on emerging economies? Do you think raising interest rates will draw capital out of emerging markets? That really depends on how the money went into that market to begin with. So if money went in as foreign direct investment, then it's going to be insensitive to changing rates in the US. So for example, Tesla built a plant in Shanghai. If interest rates increase in the US, that money's not going to come back out and flow into the US because it's a higher yielding market. It went into productive assets. Where there is concern about drawing money out of emerging markets is in financial assets. If money goes into an economy for their stock market or for their bonds, and there's heightened risk, well, prices would be depressed or would be dropping in emerging markets, and money would be drawn out, and it would go to a safe haven until it figures out what to do, which would be the US. Will it draw capital out of emerging markets? It'll draw capital out of all markets. Well, we were seeing it. It draws it out of China, out of Japan, out of Europe. Yeah, it will draw capital because it has the higher risk-adjusted return, and if money is flowing in, the dollar is also increasing at the same time, so you get two gains. You get a higher return through the yield, and you get an increase in the dollar. So yeah, it will, but not just from emerging markets. Let's see. Let's read the rest. And the Fed's unwinding their asset purchase, dollarizing 12% compared to the basket of currencies since the start of the year, coupled with geopolitical tensions, Ukraine war. The war is the war. It's all priced in. Markets are looking past that. It's all priced in. The only thing that the Ukraine war can do now is end or get significantly worse with a nuclear mistake, whether it's the power plant that gets hit or weapons being used. But as far as it continuing on, the damage has been done, and that's it. I said this a while back, that the unfortunate thing of this war is that the longer it drags on, the less important it will become. And as far as markets are concerned, it's just part of the backdrop now. It's not an event anymore, it's just there. That's all it is. Nancy Pelosi visiting Taiwan. Yeah, I don't see that as a big deal. I think that was more orchestrated than not, because, well, if you want to get some intelligence on what you think China will do, poke them. Let's see what happens. How far are they willing to go? Because based on their demographics, they're almost the same as Russia in demographics, that if they're going to do something, their window of opportunity is closing. Because their future is looking less and less bright, that if they're going to do something, they're probably never going to be as strong as they are now. So if they don't do something now, the probability of them do something 10 years from now would be lower. I don't know how much lower. It won't be zero, but it'll be lower. And the longer it continues on, the lower that probability becomes. So let's try it out with something really safe. Let's send somebody over there who's not really a diplomat per se, the Speaker of the House, and let's see what China does in retaliation. And if they just start puffing out their chest and calling us names, okay, we pretty much know that we're okay there for a while. So I think that was, if it were me, I would probably say, what we should do is get somebody to go over there and do this kind of thing, right? More strain in supply chains, high inflationary pressure leading to more countries defaulting. Yeah, the supply chain, I think, is going to be a recurring theme for the next few years. But it is what it is, and companies will adapt. We can't just, whenever there's a problem that exists, every company that is exposed to that problem immediately has an army of people on it. An army of consultants and MBAs saying, how do we work around? How do we solve it? What do we do? How can we handle this? How can we handle that? So if no government ever got involved in any problem, every problem would solve itself if there was a profit motive. If the incentives were there, it would solve itself. So I have no concern about long-term supply disruptions. Maybe supply constraints in the sense that you want 20 tons, well, only 15 tons exist, period. And it's not because we're inefficient, it's only because 15 tons exist. That's it. Well, in cases like that, all you can do is reduce demand. And when you do have a problem like that, you will find a workaround. Companies do find a workaround. It's called induced innovation. If a raw material is in scarce supply, well, the research and development department gets a little bit more funding with a mandate to find a way around this. What other materials can we use? What other composite materials can we put together that have the same properties as the raw material that we want? So I'm not too concerned about most of this stuff. There's always been geopolitical tension in this world. There's always been that. But if you look back through history, markets have, for the most part, 70% of all the time moved upwards. And when it does move downwards, it's painful. It's not pleasant. It can be psychologically depressing. But if you look past it all, markets do go up. Problems get solved. Innovation comes in. Ingenuity, creativity. That has been the history of, I think, the history of the world, basically. Anyways, there we go.